Amazon is not only one of the largest companies in the entire stock market, but they are also one of the most important companies. And I believe no matter if you are a buyer of this company or not, these earnings will have an effect not just on their stock price, but many of our portfolios. So with Amazon's earnings coming up next week, I thought it'd be a good idea to share some things that I will be paying close attention to during the report and conference call, and share how it'll impact my portfolio. But I don't want to waste your time, so let's go ahead and dive right in. Now, the biggest reason that I believe almost everyone should pay attention to Amazon's earnings is because they are involved in many key segments. They have their online stores, which is where they get the majority of their revenue from, physical stores, which is one of their smaller segments, third-party selling services, subscription services, advertising, and AWS. Now, of course, this is one company and it is not an indication of what other companies in these spaces are going to do, but I think it gives us a good idea of what we can expect going into this year, especially when you consider the fact that 2023 is one of the most uncertain years in the entire stock market, with recession fears, high inflation relative to normal levels, and high interest rates. There is no question that investors will want to try and get an idea of what Amazon's customers are going to be like. But I think if we're honest, the most important aspect of Amazon's business moving forward is AWS. And if we look over the past year, AWS is what has really held this company together because of their solid margins. However, despite having great margins, growth is going to be significantly important for the next couple of years, in my opinion. When you compare AWS to their competitors like Microsoft Azure and Google Cloud, even though the company has the greatest market share, the revenue of the other two is stronger. As some of you know, I've been buying Google, and so this will be something I'll be paying close attention to. But the reason that this is important to anyone who is either thinking about buying or holding Amazon is because AWS plays a major role in Amazon's valuation. They are currently valued at just around $100 a share, and even though that is significantly lower than before, the biggest question is what makes this a good valuation for Amazon? Just because the company has been down almost 50% doesn't mean it's undervalued. And one of the most common arguments that I've heard over the past few years is that Amazon has had a much higher PE, or price to earnings ratio. For those of you that don't know what this metric is, you take the share price and divide it by the earnings per share, or EPS. And so over the past few years, the company has traded somewhere between a 50 and a 70 PE. But currently, Amazon is trading about an 85 trailing PE with a forward PE of about 50. Now, I think a major reason why Amazon was able to have such a high valuation according to the PE was because they were a major growth company. At one point, 20% growth was almost automatic. But now that we are seeing much slower growth, can Amazon really justify that kind of a PE? But also, as many of you know, I usually only use the price to earnings ratio when I'm initially assessing companies. However, I personally like using free cash flow. And when we look at Amazon over the last 7 quarters, 6 of them have resulted in a negative free cash flow, which means that they do not have money to reward to shareholders. So investors really need to figure out what kind of growth to expect and when they are going to get back to having consistent free cash flow. With all that said, the company did announce job cuts in November, but we will probably not start to see the results until the following quarterly report, although they may share their projected results this week. If we do see some major improvements from these job cuts, this could be a good sign for Amazon. Now, there was one thing I really didn't like in their previous earnings report, and that was their current asset to liabilities ratio. The company had more current liabilities than they did current assets. This means that the company doesn't have enough assets to cover the liabilities that are due over the next year. And if the company can't cover their liabilities, then this could be a danger for Amazon. So not only does the company need to show a path back to positive free cash flow, but they also need to show renewed strength in their balance sheet. And this leads to what I believe is going to be key for Amazon, which is how they talk about guidance over the next year. I believe that much of the stock price movement the day after earnings will come from what the company says about guidance, and not simply if they meet or beat expectations. Now, of course, if we saw a significant beat or miss, then I wouldn't doubt seeing the share price being affected. But the way the company talks about guidance and responds to investors' questions about growth and margins for 2023 is going to be incredibly important. I mean, if we look at analyst estimates, they are not significantly bullish on Amazon. They have the company ending 2022 with about 8.5% growth, and next year generating revenue growth under 10% as well, which for Amazon is not great. Now, Q4 is normally Amazon's best quarter in terms of online sales and their third-party seller service, so I wouldn't doubt that continuing. But the guidance for this coming year, as savings rates are low and interest rates are high, could really impact many stocks in the stock market. Another thing that has been talked about previously is that across the board, advertising has not been as strong within big tech. And so if we see these numbers fall, this could put more pressure on other business segments to pick up the slack, once again pointing back to the importance of AWS. But also, we have seen signs of consumer spending slowing, and there is a high likelihood this could continue for the next year or so. Now, I'm not going to go as far as to say that Amazon isn't going to grow at all in 2023, but to expect similar growth and earnings compared to a few years ago is hard to believe in my opinion. I mean, if we look at this upcoming quarterly report, they're expecting to only grow between 2 to 8% year over year, and analysts have them growing closer to 6%. This uncertain time is already having a significant impact on the company. But the worst part is how their operating income has been impacted. They are projected to have between $0 to $4 billion in operating income this quarter. This is a very broad range, and when you look at the midpoint, it is immensely lower than the $3.5 billion that they had in Q3. Now, something that is interesting is that analysts do expect the company to gain back a significant portion of EPS compared to the negative earnings they were expecting last year. But even with a substantial increase in EPS, Amazon would be nowhere near their 2021 levels. In fact, their projected EPS of $1.61 would nearly be half of what they had in 2021, and in an environment where there is so much uncertainty, high margin and free cash flow companies are what investors are going to look for. And based on current expectations, I think a fair PE for the company is about a 40, which means that the company should be trading under $90, or we have to see a tremendous spike back up in EPS. Now, I will say that their Amazon Web Services, or AWS, has performed really well as they have continued to make updates and expansions that will help them in the long term. But as of now, their primary business is what's holding them back. And this is a big reason why I bought Shopify over Amazon. Now, I know this video isn't about Shopify, but I think it's important to understand the companies that could be disruptors to Amazon's primary business. When entrepreneurs are figuring out which platform to use, Shopify is more focused on building the brand, while Amazon is all about the marketplace. The problem with a company like Amazon is that you as an entrepreneur must compete against other sellers in the same marketplace. However, with Shopify, you have your own website, so the competition is not on the same web page. With the upcoming generation focusing more on branding and content creation than ever before, plus Shopify's ability to provide products for any kind of business, this puts a lot of pressure on Amazon when it comes to their online sales. And according to data from e-commerce platforms, Shopify currently has a 33% market share of online stores in the US. So in other words, 1 in every 3 online stores is powered by Shopify. When we look globally, Shopify has about 22% of the market, and this could definitely increase as we have seen an expansion into new products over the past year. Now, do keep in mind that market share for online stores is not the same as e-commerce sales. Amazon still does have a leg up, but the uniqueness of smaller businesses could push people away from Amazon's marketplace. And as these businesses scale, this could take market share away from Amazon. So Amazon needs to prove how they can still grow sales in their major business segment. Now, maybe after the recession, we could start to see incredible growth again. But if the Fed funds rate remains high, unemployment moves upward, and there continues to be a reduction in spending, we could see little growth from Amazon for the next couple of years. This could mean that the guidance for Amazon will be weak, but that leads to the possibility of a re-acceleration in growth. So it will be important to not only see Amazon's projected growth, but really see the sentiment of consumers. So when it comes to this upcoming quarterly report, the 4 major things I'll pay close attention to are AWS's growth and margins, a path back to positive free cash flow, improvements to their balance sheet, especially in terms of current assets and current liabilities, and decent guidance for the company in 2023 despite recessionary fears. As a shareholder in both Google and Shopify, understanding what is going on in Amazon's business will give me a better idea on how well Google and Shopify are performing. Now, personally, I don't want to see Amazon struggle, but I do want to see my companies outperform. And so if Google Cloud can take market share from AWS and Shopify takes market share from Amazon Marketplace, I could see a good size return for both my companies. And in a recent video, I shared the likelihood of Shopify reaching $1 trillion market cap, which if you haven't seen that video, tap right here. Hope you all enjoyed this video, and I'll see you in the next one.